Welcome back to another roundtable. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi everyone.
Thank you for joining us once again. And today we're going to debate whether lump sum investing or dollar cost averaging or DCA is a better way to invest. So let me just share a very quick story. I was once with a friend and we were discussing about investing in ETFs and stuff. And I was telling him that I prefer lump sum investing because, it makes sense kind of like when the market goes down and it's cheap, you go in. And then when it goes up, maybe you sell or you hold on. But he was saying that time in the market beats timing the market. Because when I'm waiting for the market to fall, he could be investing every month, every year. And sometimes the bull run could go on for a long time. And you have no opportunity to get in. And he's in the market every single month or every single year, every single quarter. He's putting money in. And that allows him to compound his money while I'm waiting. All right. So he's saying that sometimes probably DCA could be better as well. So we're going to find out which one is a better way to invest. We're going to pull out some research as well. But just really quickly, for those who don't know, what is the difference between lump sum investing and dollar cost averaging?
Yeah, so I think in general, the lump sum meaning is basically you save up until a certain amount, you wait for the market crash, and you just buy it, right? Yeah. That's as simple as that, right? So your DCA, which is your dollar cost averaging, is basically you buy either on a monthly basis, quarterly basis, or a half yearly basis, right? Based on your amount that you have, right?
Yeah, so let me put into the context. Maybe perhaps let's say if someone can actually save up $1,000 a month, and you can save up in a year maybe about $12,000. So for lump sum, that $12,000 will be then used to actually invest in the stock market when the opportunity comes, right? So you just pump 12,000. That's it, right? So and for a person who use DCA, maybe that person could be like saving up $100 or a couple $100 a month, and it actually make more sense for him or her to actually save up in the maybe buy only like every quarter or every 6 months, like instead of like buying every month because of that brokerage fees.
Yeah, that could add up as well.
So that is just the difference between the DCA and lump sum investing.
All right. Yeah. So some people do lump sum investing, some people do DCA, but we want to find out if there's actually, based on research and backdating the data and all that, is there actually a better way to invest or gives you a higher return? So we're going to pull out this research done by Vanguard. Okay, so Vanguard's one of the biggest fund houses in the world, a lot of ETFs under them, and this is a recent paper that they did, which is they basically says that lump sum investing outperforms dollar cost averaging. So you want to share a bit about the results of that paper?
Yeah. Okay. So for the research paper, they have actually run through a portfolio basing on the MSCI World Index, okay, from 1976 all the way to 2022. Okay, so what they did is they basically do a front loading of investing in the market using $100,000 for a lump sum. So meaning to say that at the start of the year they just put in $100,000 in the market, and then by the end of the year they will just measure the performance across different time frame of the MSCI World Index. Okay, and then the other strategy that they use to compare to measure the performance differences is the dollar cost averaging, where they kind of like dollar cost averaging over the initial first 3 months, and then subsequently for the next 9 months they just let it run. Okay, so a bit kind of weird, but it's kind of just to show you that the difference between dollar cost. If you just were to delay a little bit of the deployment of capital, how is the return is going to be like? Okay, so based on their research, what they found out was that lump sum investing actually outperforms the cost averaging style, okay, over 68% of the time.
On a yearly basis.
On the yearly basis, based on their cutoff on the yearly basis at the start of the year, end of the year, and then they just measure. Okay, in fact, based on their data here, okay, the table, they on average they actually found out that lump sum investing, if you have 100% equity type of portfolio, okay, you are going to achieve $111,940. Okay, so basically about 11.1% performance, versus if you were to dollar cost average it, all right, based on the initial first 3 months, all right, front loading exercise over the 3 months, you're gonna get about $109,580, right? So that will be about 9.6% performance versus 11.1% performance.
Okay,
if you were to use the lump sum strategy. Okay, so basically they found out that lump sum will outperform cost averaging style of investing.
All right. So this methodology is a little bit, like you said, a little bit weird because usually the way I would lump sum is I will wait for the valuations to be cheap and then I come in.
Yeah.
But like you said, this is just a study done by Vanguard, so they've done all the research and the methodologies is stringent and everything, and lump sum looks like a better way to invest. And
based on their research, right? So again, everyone definition of lump sum and dollar cost averaging can be very different. So like you may be waiting for like crisis to come and then you invest, right? But in this research, they are just doing lump sum every year. So to me, it looks like a dollar cost averaging every year.
Okay.
But anyway, they research basically proven that lump sum actually beats the dollar cost averaging, but cost averaging will beat cash 69% of the time. Okay. So if you are just waiting for the cash, like waiting for the market to crash, and then you just sit on the cash most of the time, you will underperform.
And you never invest. Basically, the cash just inflates the value.
But they measure it based on the 3-month short-term treasury yield kind of return. Okay. But then 69% of the time, either you are cost averaging or lump sum, you will beat that.
Okay.
So you just sitting on the cash.
Okay.
That is where I think your friend could be arguing that, hey, why are you sitting on the cash? Research has shown that you should just invest in it most of the time.
Yeah, that's true.
Yeah.
Okay. So I've read other papers as well, and they seem to point in the same direction, which is lump sum investing. Overall tends to be better. So someone who's watching this, maybe they're dollar cost averaging right now, they could go, then should I switch my strategy from? Maybe they've been doing it for many years. Like they've been doing it for 5 years, dollar cost averaging into some broad-based ETF. And now they hear this or they look at research reports and then it goes, oh, should I switch my strategy? Is that something they should do?
Yeah, I really think it depends on the psychology of the individual investor, right? So at the end of the day, right, people who want to do lump sum, right, as much as, let's say, based on this research, is like maybe starting of the year you invest, right? There's a rule base. But then when you want to do lump sum, most of the time you're trying to get the best time.
Okay.
Right. So you psychologically you always want to like, okay, I want to buy the best because you're going in one big sum, right? But then the best time is always the market crash, right? And at the point of time when the market crash, you don't expect cheap valuation and good news.
Outlook, yeah.
Yeah, it's always cheap valuation and a lot of bad news, right? So mentally, right, it's quite damaging to the mental states because most of the time people don't dare to pull the trigger. So eventually, if you are a new investor, you do lump sum, right? It may prevent you from actually investing or pressing the button, right? So I think in general, if you are those who very worried about volatility, if you are very worried that market crash, then I think dollar cost average makes more sense, right? It forces you to don't look at the market, but you just keep buying regardless whether the market's up or down, right? I think there's also a lot of empirical research out there that already shown that if you have time the market bottom and you have dollar cost average, yes, the time market bottom does outperform the dollar cost average. But then if you look at the returns,
it's not that big of a gap.
It's not that big.
Okay.
Not that wide, right?
Okay.
So at the end of the day, I think you want to, if you are really working for somebody, right, you don't have time to do research, you don't want to look in the market in and out, I think it makes more sense to do dollar cost average and it's better for your mental state.
Okay.
Right?
So it really depends on the individual.
Yeah.
Some people just can't take the volatility.
Yeah.
They want to remove themselves from the equation.
Yes.
They just go in every month or every quarter. But some people, they like doing these kind of things.
Yeah.
Like for you guys, would you? I mean, I'm just
Lump sum.
jumping ahead right now. Would you do lump sum or dollar cost averaging?
I would. So far, I've been looking at my style investing, been lump sum.
Lump sum.
Yeah, and I usually will go to the market where it is depressed.
Okay.
When there's a big crash or when there's a lot of fear in the market, that's the time where I will be in. Yeah, so lump sum I think suits me better because I think I'm full time right in this. So and I know what I'm doing, right, and I don't get scared easily during the bear market. I mean, not many people.
You get quite happy actually.
Yes, yeah. So
your mood improves.
So some people, when you talk to them during the bear market, you can see that they're panicking because their portfolio have drawn down of 20%, especially if it's a big portfolio. I think some people just get scared. Right?
I have that experience.
Yeah.
Yeah.
I mean, not for me personally, but I have people that I know that really just get irritated when the thing goes into the red.
Yeah.
They just get irritated at that.
Yeah. So that is something that you can't escape if you invest in the stock market. Right? I mean, I learned to accept it. At the start when I go through the first down cycle, I kind of like scared. But over time I just get kind of like see this as an opportunity to really pump in more money. Yeah, so lump sum is more suitable for me. But if let's say I'm like, not doing this full time, I'm not interested in investing. But you hear a lot of people say that you should invest in the stock market because it has shown historically has outperformed across all other instruments out there, right? So, and if I'm that category and I don't really have time or not interested in investing, then I'll do dollar cost averaging because if I'm just a normal fox reading news out there during the bear market, I may scared if I'm doing lump sum because why would I want to put money when everybody is selling and the market is crashing, right? So that psychologically is I think what Peter is trying to say, right? And it's not easy in a downturn when everybody is so negative about the market. Everyone is telling you to sell, and you still have to go and buy using lump sum that you just save up. It's difficult to pull that trigger.
Yeah. So I think at the end of the day, I think I more prefer towards the dollar cost average.
Okay.
Why? Because at the end of the day, if I really have the time. And I want to do lump sum because when you talk about lump sum and dollar cost, right, it's usually broad-based index, right?
Okay.
So if you really have the time, you probably won't invest in the index, right? If you're doing full time, you want to invest in individual stocks and all this, right? So at the end of the day, you still won't invest in index. You won't use the lump sum strategy on that. So and you look at most people, if you are working on a daily basis, like Rusty said, no, you got no time. You don't want to spend time research. You should do dollar cost average. I think I'm more favor towards dollar cost averaging.
Okay. I mean, for personally as well.
Yeah.
Okay.
And also because of the market that I started investing in, it used to be Singapore, and then subsequently Hong Kong, and then after that I moved to US, right? So it depends on which market you are doing this strategy.
Yeah.
If you are doing dollar cost averaging, right? I mean, people have argued that ETF, a lot of ETF for that long argue that is the best strategy to go, right? To do dollar cost averaging, right? But if you do that strategy on Japanese market, right, since 1990s, no matter you're using lump sum or dollar cost averaging, it's just both just not going to work because if you look at the index performance since 1990s, that was the peak. Until today, the Japanese market is still down.
The last
I think
3
that's
decades.
the only index that really break the theory that they always say the index will always, the stock market will always go up. That's the only one that breaks the theory.
So like if you do lump sum like what I've been using for Japanese market, I will only buy whenever there's a crash. So that strategy might work better. Okay, because during the bear market, during the sell down, that should perform well. Okay, so and if you use dollar cost averaging, I think the return is going to be disaster, right? Because you're buying from the top all the way down and then up again, but then the whole index is just down, right? I mean, STI also has gone through that same phase for the last 20 to 30 years. It's been quite flat, right? And Hong Kong also has been quite flat over the last 10, 20 years. Okay, in fact, if you look at the last 5 years, Hang Seng Index actually down by close to 40% to date, right? So last 5 years, okay, and the market that has done very well is of course is S&P 500, and also the MSCI World Index that they used to do a study on it. It actually has a heavy weightage on the US market. I think you have about close to 70% of the weightage in the MSCI World is actually made of US market. So whatever that we say here, I mean, it's all based on past result. Okay, and it's not we don't know how the future is going to look like.
So there are a lot of assumptions that you have to take into account if you're going to do dollar cost averaging. Number one is, like you said, it has to be a broad-based index, because if you go into a particular industry, I mean, there's so many ETFs nowadays. There are ETFs for EVs, for AI. You can't dollar cost average into these things because you don't know. This works for a very broad-based index like the S&P 500, QQQ maybe.
And they're very diversified in all different
Very
industries.
diversified. And then, like you said, it has to be a market that's on a long-term uptrend. Which is the miracle of the US. It's been for 100 years. It's been doing tremendously well despite all the world wars and all the recessions. It keeps going up, but that's in the US. And Japan is a opposite case.
Only until recently, like last 5 years, I think Japan has done quite well. It has outperformed. It has gone up by close to 20%. And I mean, I'm just comparing the basket of indices like United States, Singapore, Hong Kong, and Japan, and then you get to see that I think US is the best, right? And then followed by MSCI World, which is the whole world, right? But again, the MSCI is
towards the US.
Weighted towards US. Okay, so if you look at STI, it's flat last 5 years, and then you look at Japan, it has gone up because of the recent a lot of corporate companies in the US is trying to do a lot of share buyback and pay out more dividends, unlocking the shareholders' value. So markets are like that kind of behavior. But over the last 10 years, you get to see that I think more markets done lot better if you look at across the board. Okay, and STI is still flat.
Okay.
Okay, and then you go to 20 years period, most market has gone up actually by 50% to as much as 400%, whether in the US, Japan, or
But
whichever.
that's the other thing. If you do DCA, your time horizon has to be
long.
long, 10, 20
Yes.
years.
Yeah.
Because if you do that and then you expect to cash out in 5 years,
Yeah.
you have no idea where the market's going to be.
I
in
think
5
if you want to do
years.
DCA, your horizon should be more than 20 years.
Okay.
That's what I
Mm.
take, because there's periods where the market can be. There's one period where US was down below Asian stocks, right? Then
Okay.
then now they are up and Asian stocks are down. So you want to ride through the cycles, you have to be at least more than 20 years.
Okay.
Correct. And if you look at 30 years, it's even better, right? I mean, US actually has gone up almost tenfold, right?
Yeah, wow.
Yeah. So, but most market has gone up. Then nothing you see in the negative territory, okay? Except Japan, of course. If I stretch out to 35 years, Japan will probably stay in red,
Mhm.
right? Because of that bull market that they've gone through, right? So it's a lost 3 decades for
Yeah.
Japan.
Yeah. So that means if you broad base, you want to perform like he shows you the chart that 30 years, most of them actually perform. So you want to increase your probability that your dollar cost
Yeah.
actually works, right? You have to have a plan that is for 30 years, right?
You're gonna
It's for retirement when
you're
you do
gonna,
dollar
like,
cost
you're gonna married to this
Yeah.
thing for 30 years in a way.
Yes, yeah. So that's why they always say that long-term investing is still the best way.
But there's no guarantee
to-
still, right?
Go, yes.
Yeah, there's still no
So
guarantee.
if let's say in the future we have some, I don't know, another COVID-19, then wipe out half of the human
Oh
population.
no, that's bad.
The whole market will just opposite, right?
Okay.
Whether you're using DCA or you're using lump sum, it's just not going to
I
work.
mean, there are a lot
that
more
work.
worries if that really happens.
Yeah, so I mean, we're talking about future. So
Yeah.
I think lump sum dollar cost averaging, we all can argue until the cows comes home,
Yeah.
right?
Okay.
But at the end of the day, it really depends on how we move to. I mean, nowadays we easily have a press of a button nuclear war, and just
Okay.
wipe out the entire
Yeah.
nation, right?
Yeah.
Yeah.
So I think at the end of the day, I think there are benefits to both approaches,
Yeah.
and it really depends on your personal
Yeah.
Risk appetite.
risk appetite and how
Yeah.
you basically, whether you have the time,
Yeah.
whether you want to, like you said, if you do lump sum, you're going to know valuations as well.
Yes,
Yeah,
you
yeah.
need to do slightly more work.
Yeah.
Yeah.
So it really depends on the individual and it's really up to you. So
Mm.
there's no right or wrong, it's really what fits you better.
Yeah.
Yeah. So I think these are the considerations that you need to take into account. So there's no need to jump onto one approach or the other.
Yeah.
But the returns seem to look better on lump sum. But
Yeah.
it's not like a huge difference that
Big
you got to
difference,
do
yeah.
it that way.
Yeah.
Okay.
I think what makes the huge difference is that if you are treating investing as a binary case, like all in or all out,
Mhm.
all right, then that is very risky, right? Because investing is not a binary option. In fact, you have to really stay in the market. That's why timing the market is more important than timing the market. Okay, so
Okay.
80% of the time, my money is in the market.
Mm.
Yeah, so I
Yeah.
think that
So
then
it
the
still holds
rest,
true. It's just
Yeah.
that you're dialing it.
yeah,
forward or
adjusting it.
backward, yeah.
Yes, increase my allocation during the time where there's a lot of bear market, and then after that during the bull market, then I'll sell on more on cash
Mhm.
and maybe look out for fixed instrument, short-term fixed income to
Yeah.
park the money there. Yeah.
Okay. So I hope that was pretty useful for you if you're wondering about lump sum versus dollar cost averaging. We'll put the links to the reports as well. You can have a look at it and see what, how they do the methodology and all that, and if you're interested to read about that. But I think that's pretty much it, right, guys?
Yep.
All
Yep.
right. So my name is Adam. That's Rusmin, Victor.
Thank you.
Thank you for joining us. If you like this roundtable, please hit the like button. Any questions about this, put them in the comment section. Of course, subscribe to our channel. Many more roundtables coming up, and we'll love to see you again.